All right, all right. We're back again with another great episode of PFREI, a passion for real estate investments. I'm your host, Fuquan Bilal. And today we have Gino Barbaro on the show with us. It's great. I watch your podcast, man, the Jake and Gino show. You guys are hilarious. You share a lot of great information. I was like, I got to get these guys on the pod. So thank you for being here. I'll read your bio real quick, then we'll jump into it. So Gino is an investor, business owner, author, entrepreneur. As an entrepreneur, he has grown his real estate portfolio to over 1,900 multifamily units and 250 million in assets under management. Gino and his partner Jake are teaching others how to do the same thing through Jake and Gino premier multifamily real estate education community. To date, their students have closed 57,000 plus units and have $4 billion in volume. That's huge. He's the best-selling author. He's the best-selling, I'm almost done. He's the best-selling author of 3 books: Wheelbarrow Profits, The Honeybee and Family Food, and the Prairies, like Little House on the Prairie, the Prairies.
Friars.
Friars. Oh man, I was doing so good. He currently resides in St. Augustine, Florida, with their beautiful wife, Julie, and their 6 children. Welcome to the show, man. I appreciate it.
Thank you. It's a really long bio. That's why I'm like, let's get this show on the road. We got limited time here. We got to let it rip. And thanks for having me on. And I know you're in San Antonio. You're out there golfing, have a good time. I'm in Florida. We're escaping the Northeast weather for the wintertime. So let's have a frank conversation about real estate and what it's done for my life and, basically what it's done for your life, right?
Absolutely. Absolutely, man. So just jump right into it. The first question I usually ask the guests is, why are you passionate for real estate investing?
My story is not as sexy as yours. I wasn't shot 6 times. I don't have anything that earth shattering, but what I do have is a story that resonates probably with a lot of the listeners. I was at a job. I had a restaurant for years. I liked it, and then I didn't like it. And at one point I said to myself, I just hate doing this. I'm working harder and I'm making less. It was around the 2008 recession. I read a book by T. Harv Eker, and Secrets of the Millionaire Mind, it changed my life because I'm blaming everybody out there. I'm blaming the government. I'm blaming Obama that he got elected. I'm blaming the economy. I'm the one who doesn't have the skills. I deserve what I get. My paycheck is a reflection of my skills. And at that point, I said, I need to skill up. I went out, I sought mentorship. I had already done a couple of really bad deals. I said, let me focus and learn on how to underwrite a deal. Maybe learn what a cap rate is, right? I didn't know any of that stuff. I learned it. And fortunately for me, I met Jake in 2009. And we decided to partner up. He moved to Knoxville, Tennessee in 2011, and I was still up in New York. And that's when we started investing. It took us 18 months to find our first deal. And really, to answer your question of why I'm passionate about real estate, it is probably, in my estimation, other than starting a business, one of the best ways to create wealth, to keep more money of what you make. It's really a great tax, shelter. I don't know whether we call it a tax shelter or really amazing tax benefits. It's a great place to create some type of yield monthly. And honestly, it's one of the best investments where you can also use it as a scalable business. We've been able to scale our multifamily from, that first 25 unit property to over, like you said, 1,900 units total. We have a 1,600 in the portfolio right now because we've cycled out of a few hundred, but it's just an amazing vehicle. And for me, I was stuck in that rat race where I had that one restaurant and I could not break out of it. And I saw multifamily. I couldn't fix and flip because I had the full-time job. I couldn't do that. So I'm like, well, multifamily is a vehicle for me to passively start on my first and second deal, figure it out, and then try to ultimately scale up and leave the restaurant job. And once I did that, full-time into the real estate business.
Now, when you said you cycled out of a few hundred deals, let me just guess, would you cycle out of all of your Class C?
Well, good question. and that's the first lesson, right? What I understood about real estate when I first started out was buy and hold forever. No exit strategy. That's the biggest mistake I think any of us investors can make, is just going in and saying, hey, I'm going to buy these deals and I'm going to hold them forever. When you first start out, you're buying older properties, more marginal areas, median incomes are lower. Nothing wrong with that product. But as you start learning and as the market cycle starts to shift, remember when I started buying it back in 2009, 2010, 2011, those older properties were really value adds. They were really depressed the prices. You can get them for good prices. You could fix them up and flip them. Ironically, we still own our very first deal. It's a 25 unit. We still have it, it's 10 years later. We bought it in 2013. And we started doing was we had a couple of syndications. We cycled out of those because we needed to get paid. We couldn't refi those. So 2 of the syndications came off. And then we had a couple of properties that were a couple 8-unit properties, a 20-unit property. And that part of the cycle where, hey, this property's older. The cycle is high right now. It has PTAC units. There's no central air. There's a little bit of foundation work. Let me get rid of that property, take the money and repurpose it into the next property. So if you think of real estate, it really is a business, and we call it the conveyor belt. When you think of a conveyor belt in front of you, you want to stack assets on this imaginary conveyor belt, and think of it as the 5-year conveyor belt. Year 1, you put a house on there. Year 2, you may have another house and a small multifamily. Year 3, you may get a couple of the small multifamilies. Well, in year 3, that first house and that first multifamily is starting to matriculate. You can roll out of that, get the equity, and start putting into the next deal. And if you can imagine that, it's a business, learning how to buy. Because for Quan, you can always buy real estate. It is always the right time to buy real estate. You just need to know what strategies and what your buy right criteria is. It's not always the right time to sell. So stacking those deals on a conveyor belt where, man, eventually one day, you make money, you got the equity, you're either refining it out or selling it and putting it into another deal. That's the power of real estate.
Yeah, I mean, I heard a few things there. Got started in 2009. I was actually just, I still was picking my face up from the floor because the market had just crashed probably a year prior, and I was going through it. I was doing all fix and flips, and the rentals that I were doing was smaller rentals, 3 family, 4 families. Once the market cycled back and I got back on my feet after 2010 and started buying again, I was building my portfolio with rentals because I was very transactional heavy with the flips and didn't have any income, which really hurt me in the long run when the market crashed. But what I'm trying to get to is I learned that having that rental income and learning how to play the asset manager role and manage a multifamily was important, but I didn't take action right then and there with the bigger multifamilies. And it really didn't happen until almost 3 years ago, where it took my older son to say, Dad, I've watched you for so long and you have all these properties, all these multifamilies. How come you never just bought the big buildings? And I was in my comfort zone. And it seemed like you started off right there. So you already was, fast forward, like, okay, I want to get started with this. You invested passively and you had that mindset to do that. And I really, in hindsight, really wish I would have had that thought process to do that, because I love it. And the last time we spoke, he was like, dude, you're doing fixed and multifamily. How come you just don't do just multifamily and just do one thing? And I thought about that after we got off the call. I was like, wow, why do I do that? For me, it's really having a diverse approach, because I run a fund and I don't want to have just one strategy. I want to be diversified to, especially in this marketplace. But yeah, I commend you guys for just staying laser focused, putting your head down and building out that portfolio, man. And I love it.
And for Quan, that was a learning process for me, because in 2005, I met a guy that I affectionately call Maserati Mike. Guy was driving a Maserati, and he said, Gino, you want to invest with me? I said, sure. My partner, my accountant, introduced us. My accountant had been doing deals with this guy for a few years, and he had brought a mobile home park deal to me. Now, it was a great deal. He wasn't a great partner. I should have done due diligence, didn't know what the hell I was doing. I gave the guy $172,000 and he took the money, and about a year and a half later, he squandered it. And I look back at that deal and I say, well, he was a terrible partner. Yes, but it comes back to the 2008 epiphany of I'm the responsible one. Just because I have a terrible partner, I chose that terrible partner. I didn't get on a plane and do due diligence. I didn't see his references. I didn't walk the property. I didn't know what a cap rate was, remember? And 2 years later, I went out and bought a strip mall up in Dutchess County, New York. Same thing, made the same mistakes. Didn't know what a commercial lease was. Didn't know the market cycle. Didn't get the proper debt. Didn't buy right, manage right, finance right. It was on me again. And those learning lessons really stuck with me. I'm saying I need to get really good at something. And for Quan, it's been really difficult the last couple of years. Like you said, staying in your lane. being diligent, learning how to create wealth. You need to become an expert at whatever you're trying to do. And these last couple of years, we've only bought a couple hundred units. I wish to say we could have bought more, but prices were elevated. It wasn't our time to buy. Now we're lucky. We just closed in a deal 2 weeks ago, 128 units. So it seems as if the market's starting to shift and things are starting to move. But to be able to say to yourself, this is what I want to focus on. This is what I need to get really good at. This is what I want to stay on. We want to become the Chick-fil-A of apartments. What does that mean? Have customer service? Well, then we can't be doing RV parks and can't go into mobile homes because that's a different management play right there. We don't want to reinvent the wheel with that. So we want to get really good at this model here of multifamily. And then you can ultimately build different streams of revenue off the multifamily. You can syndicate deals. You can start developing multifamily like we're starting to do. You can start an education company. You have all of a sudden the property management company as well. So there's other ways to build revenue around that vehicle that you're selecting. You could do the same thing with single families. All of a sudden, you're doing a single family home. You're doing a fund. You're lending money privately to people. You are doing education around it. You're holding a couple for rentals. You start a title company. Maybe there's so many different ways to create that what we call multifaceted approach to the business. But if you get really good at that core investment strategy, whether it's mobile home parks, whether it's self-storage, whether it's commercial, whether it's office space, you get really good at that and you learn the market cycle and how to buy that asset and how to dispose of it and the exit strategy, I think anybody can become successful.
Yeah, that's a very good point. And just to echo what you're saying, well, as our good friend Larry Yacht says, success is an optimized daily experience is an optimized experience that's sustainable over time, right? An optimized daily experience sustainable over time. That's what it is, right? So having that success in the business and doing what you love is important because that pushes you to the next level, having that optimized daily experience that's sustainable over time. But with the market that we're in now, you kind of spoke to that. You guys bought a few deals. You're not buying as much because I believe there's a market for great deals, not good deals. And there's challenges finding great deals with the right cap rates, with the right value add approach. What are you guys struggling with? Or what challenges are you facing? Because we all face challenges, right? In this current marketplace on finding those deals to constantly build your portfolio.
I don't want to lead with this statement because we've all said it before, but this economy is pretty crazy. I mean, you have jobs being lost in certain sectors and you have 500,000 jobs being created in January. It makes no sense. Do we have inflation? Yes. Interest rates are rising. Things are slowing down. Housing makes up 16% of the economy. I didn't know that. I read that today. So as housing slows down and you see trends, I mean, prices here are down 20%. So that should affect what's going on with the economy. You would think prices would readjust quicker. I think in multifamily, the sellers are still thinking about a year ago. The cost of capital has gone up. We're looking at deals that were 3.5% a year ago. They're at 6% right now. So prices have to come down. Brokers know that. Sellers aren't getting the memo yet. So the only true value that I see is if you can find a motivated mom and pop who needs to sell, and a lot of them need to sell. A lot of them are off market. And it's really weird. The deal we just did, the seller did not want to put his deal on the market. He didn't want to let his residents know he was selling. He didn't want to let his employees know he was selling. He wanted a smooth transaction. He'd had a bad experience with the broker. So that's where the opportunity lies in this part of the cycle. Being patient, letting things work itself out. People are going to start having problems with a lot of these syndications. They're not going to be paying their preferred rates of return. They're either going to have to trade out of the deal or actually dilute their investors, one or the other. I think this bridge debt coming due sooner or later is going to affect a lot of the valuations as well. And I think there's going to be opportunities. Sellers are going to have to come to the table, the ones that have to sell. Now, if you're a seller and you don't have to sell, you're in the driver's seat because rents have dropped a little bit, but they're going to continue their upward swing. You know that's how it is because there's not enough affordable housing. There's not enough people buying homes. They need to rent. And if you're in an area where it's growing, where they don't have enough supply, like a San Antonio or like an Austin or like a Knoxville, people are moving there and there's not enough supply coming online. Rents are going to continue to rise. So people, through no fault of their own, have been lucky in the last couple of years. Buy a deal, rents go up for doing nothing, and that's where we are right now. I just think there's going to be opportunities. I just think that the economy is going to slow down. We're going to have a recession. Prices have to drop, and the people who are patient and have been in the market and have built those relationships with brokers are going to be seeing those deals, Juan.
Yeah, I'm actually getting a lot of deal flow now from brokers, but like you said, the sellers still have their head stuck in the sand and they're not adjusting with pricing. For those deals, I'm being a little bit more creative with my offers and going, hey, seller financing.
Yes.
What are you guys doing? You know what the market is. We want higher LTV. We want seller financing. We want, 3 years of interest only. We want you guys to become the bank. We want to put 10% down. You hold the paper, especially if they're not if they don't have the occupancy. So
Yes.
trying to structure those type of deals and being creative. And a lot of those are falling out. I'm like, if one stick, then it works for me. That's all I'm going to offer in this market for those off-market deals from the mom and pops. But they're still trying to see, and I don't think the brokers are doing enough to encourage the sellers. I think the brokers are somehow trying to keep hopes because the more it can sell, the more commission they make. And I just don't think there's enough brokers beating the drum and telling the sellers when they come to them with the opportunity, we're in this market and you're going to have to be flexible.
I had an aha moment the other day. We interviewed a gentleman named John Warlow. He wrote the book Built to Sell, part of the small giants world. And he was on the podcast and he's like, I don't know anything about real estate, but what he basically said was, because he's trying to teach people how to build their companies to be able to sell for multiples. So the goal is to sell a company that has 10 million in revenue so you can sell to private equity. And he was talking about private equity, and private equity has come down into the real estate space over the last couple of years, and they've gone into multifamily. And that's what's really driven up the price. Why? Because the cost of capital was so cheap. They're basically buying an asset for, 80% levered, 20% that they're borrowing the money, and they're getting that money so cheap, they're able to optimize that asset and flip out of it. And that's what they've been doing. But now they've come up against the wall. A lot of these projects that are green, they were funded by cheap money. Now that money's a lot more expensive, that's slowed down. So it takes time for this stuff to trickle through the economy. And now private equity is like, not 3.5 anymore. It's 6.5 sometimes. So they're pulling back. A lot of that money that was floating around, having to find the place, well, it's not finding that place as much. So when there's less demand for the asset and more supply, hopefully that's going to happen. I think prices will need to adjust. And I just think brokers are also stuck in that realm where, hey, for the last 3 or 4 years, it was great. Calls to offer. You got 20 calls to offer above asking. They didn't have to do the work. But I'm going to tell you right now, I've gotten on my computer the last few weeks, I've gotten brokers reach out to me, send me deals in my market that are like, hey, price isn't there, but they're sending the deals and they're actually cold calling. So it's getting back to the buyer's market. When you start seeing brokers cold call you, that's a good thing. That means that there's not a lot of activity out there and they need to drum up business. And those are a few of the signs: the private equity, the cost of capital, brokers getting to be hungrier again. Those are all really good signs that the market is starting to shift. And I see you smiling, and I know you agree with me.
Yes,
That's
100%,
what happened in 08 and 09. And things repeat themselves. And those of you who are young out there, now's the opportunity to get into multifamily or get into any kind of investment. Hopefully you have some money set aside. The big thing about 07, 08, for a lot of us, myself included, we didn't have capital set aside. We were all in. We're taught, let's invest. Every dollar needs to chase yield. We're going to risk everything. Well, hello, you do that when the market shifts, and inevitably it will. You, number one, will have the liquidity to stay afloat. And number two, you won't have the liquidity to take advantage of any opportunities. So hopefully now people have learned they've got some money, whether in a whole life policy or in savings accounts. So when that money, that shift does occur, it's like, okay, I've got the opportunity in front of me. Let me place that capital.
And now it's time to pounce. Yeah, those are all good points. And oh man, this is really good stuff. What do you have to say about the people who are kind of just now getting into multifamily? What should they be looking for? You did mention, and I was smiling because I am getting the calls from the brokers. I am getting the emails. When these were guys I was chasing and asking for deals and hounding for deals, now I don't even have to do that. And I get several emails a day. I get text messages to my cell phone. I get calls, voicemails. I'm like, wow, I was chasing this guy for this deal in this part of Georgia for like 3 months, and he never answered me. And they never answered my LOI when I sent it. And now he's calling me. What's going on? Am I special?
He's calling you because you chased him. That's why. That's persistence right there. And that's understanding that that's part of the cycle. For that, the question you answered it's a very important question, because I wish I had an audience in front of me. I always love to ask people this. Did anyone think that the market was at a high in 2019? Everyone raises their hand. How about 2020? Everyone raises their hand. How about 21? How about 22? And I say to a lot of people, what held you back from investing in real estate? Well, I thought the market was at a high. Well, what about now? Well, now the market is correcting and we're going through recession. You can't have it both ways. You know what I mean? Like, you can't time the market. If you're in this for the long term, 1 or 2 years out of a 30-year track record, what does that mean? It's a blip on the screen. I mean, start now, because you need to build those relationships and the market's going to change. You need to learn how to do a property tour. You need to learn how to select the market. You need to learn how to speak to brokers. You need to find the money, right? Those are investors, and also find the deals. Because if you find a deal and you need to raise money, but you have no investors, good luck. You can't close in that deal. So you need to be sourcing capital and sourcing deals. So don't wait until the crash, because nobody knows when the crash is. The only time you know when the market is hit top and it's actually at the top is looking back and going, oh, there was the top 6 months ago. You'll never know what it is. But if you're in it and you constantly are grinding, calling brokers up, and they're not returning your calls, one day they will come back and return your calls. You're like, oh, but if you're on the sidelines just waiting, man, that is the worst place to be, because you're complacent and you're always making those excuses. Someday I'll. And I was there. I'm not criticizing anybody, but let me tell you, multifamily and real estate, and it's just an amazing business. The tax benefits and the ability to have cash flow. And is it hard? Absolutely. But what's harder? Is it hard working for a boss, having to work 50 hours a week, and you're not controlling your own destiny, making that person rich? That's a hard gig too. I mean, I had a restaurant. I had one pizza shop. I worked on the weekends. I worked on the holidays. It was in New York, so my ass would have been shut down during COVID. There's risk in that also. There's risk in everything we do. I would just rather have the selection to live an autonomous life, to try to create a small business with real estate and to try to control my destiny. I don't want to worry about what Disney puts up on their screen and have the shareholders and have the CEO screw things up. I'd rather be my own CEO, take my own risks, and then learn from those risks and continue on.
100%. Oh man, let's give the audience an opportunity to plug your social media channels and where they can get some of that multifamily education from.
Just go to jakeandgino.com. Fuquan, you see behind me, we've rewritten
I see it.
books.
I see it. Jake and Gino, all the books, I see them.
Yeah, just go to the Jake and Gino channel. I mean, with the podcast is there. Fuquan was on the 100-year podcast, and I liked it because it was about long-termism. I mean, really, to create wealth. Creating wealth is really boring. It's not a sexy thing where you're in crypto, you're buying Bitcoin at 3,000 and selling it. That's not how you create wealth. That's just a fantasy. That's a great way to talk about it. Creating wealth is doing boring things, having the discipline and the diligence to learn a craft, to invest in yourself, and to think for the long term. And I think that's what's important. That's what the 100-year show talks about. I have a show with my wife called the Julia and Gino Show, the Jake and Gino Show. We talk to high-level entrepreneurs. So just go to jakeandgino.com and just check out all of our socials. It's all on there.
Oh man, I want to thank you for coming on the show today. This was a great episode. I hope you guys got a lot from it. Make sure you go to jakeandgino.com, check all it out. If you're watching this on YouTube, be sure to like, subscribe, and share. And be sure to catch us on all the other podcast channels or wherever you can find a podcast. Another great episode of PFREI, a passion for real estate investments. Fuquan Bilal signing out. Thanks for coming on the show, man. I really appreciate it.
Thanks, Fuquan. Take care, everyone.